Imagine waking up one morning, no longer worrying about filing your income taxes, no endless paperwork, no check to the IRS every April, no wondering how much of your hard-earned money will be taken before it even reaches your pocket. It sounds almost too good to be true, right? Well, today, we're diving into an idea so bold, so radically different, that it could reshape life in America as we know it. Former President Donald Trump has floated a plan that could eliminate income taxes for Americans making under $200,000 a year and fund it all through tariffs collected from imported goods. At first glance, it feels almost magical. No income taxes, funded by foreign companies paying tariffs. It taps into something deeply American, the dream of keeping more of what you earn and seeing your country thrive through its own ingenuity. But before we start celebrating or sounding the alarm, let's take a breath and a hard look. What would it actually mean to replace the income tax with tariffs? Is it a lifeline for the middle class or a ticking time bomb for our economy? Today, we'll walk together through the real numbers, the potential winners and losers, and the deeper story behind these flashy headlines. We'll look at why Trump's hands-on negotiation style matters, why companies like IBM are making massive bets on American soil, and why, behind every bold promise, there are risks few people are talking about. So grab your coffee, settle in, and let's start by pulling back the curtain on what's happening behind those closed doors in the Oval Office. Because understanding this now could make all the difference for your future. Let me ask you something. When was the last time you saw a U.S. president personally walk foreign leaders into a negotiation room? Not just for a photo op, but to actually sit at the table and lay down terms? That's exactly what Donald Trump did with the Japanese delegation just a few weeks before this clip was recorded. He didn't just hand off negotiations to trade reps or let diplomats do the talking behind closed doors. He opened the conversation himself in the Oval Office before walking his guests into the negotiating room like a CEO preparing for a high-stakes merger. Now, say what you will about Trump, love him or loathe him, but one thing you can't deny is that he approached global trade not like a politician, but like a businessman. And for better or worse, that was a shift. This hands-on style wasn't just symbolic, it was strategic. He wanted to send a clear message. I'm not outsourcing American interests, I'm leading them. Take the U.S.-Mexico-Canada agreement, USMCA, for example. Trump scrapped NAFTA, a deal many Americans, especially in the Rust Belt, blamed for job losses, and replaced it with something he claimed would protect American workers better. Was it perfect? No, but even some critics admitted it was an improvement in key areas like labor enforcement and digital trade. What's also important is that Trump's personal involvement raised the stakes. Countries knew that they weren't just negotiating with bureaucrats. They were dealing directly with the U.S. president, someone who viewed trade as leverage and tariffs as weapons, not just policy tools. Now, of course, this style had its downsides. It made some negotiations unpredictable. It sometimes alienated allies. And yes, it triggered some volatility in the markets. But here's my take. For a lot of Americans who felt ignored for decades, people in manufacturing towns, farmers, small business owners, Trump's direct engagement signaled something powerful, that their struggles weren't just statistics on a spreadsheet. They mattered enough for the president to step into the room himself. And even if you disagreed with his methods, that kind of visibility, that kind of boldness, was something many hadn't seen in a long time. It changed the dynamic. It raised expectations. And it made every deal or failure feel personal. So now that we've looked at the man behind the negotiating table, it's time to look at the numbers behind his promises. Tariff revenues hit a record high under Trump. But is that really enough to rewrite America's tax system? Let's take a closer look. $15.9 billion. That's how much the U.S. collected in tariff revenue in a single month. A new record that caught everyone's attention. But here's the question I can't stop asking. Is that number truly as impressive as it sounds? Let's break it down. That $15.9 billion didn't just fall from the sky. It came from duties placed on imported goods. Everything from electronics and steel to furniture and clothing. Industries like consumer electronics, automotive parts, and even grocery-related imports played a big part in generating that revenue. When tariffs are imposed, importers, and ultimately, consumers, pay more. So yes, on paper, the government is bringing in money, but it's not free money. That's one of the biggest misconceptions I see floating around online. Tariffs are a tax, just not on income, but on consumption. We pay for it at the checkout line. And when you look at this $13.9 billion through that lens, the real question becomes, is it worth the trade-off? Let's put it into perspective. If the U.S. collected $15.9 billion on an April, that annualizes to around $190 billion a year. Sounds like a lot until you realize that the federal government collects over $2 trillion in income taxes annually. And if Trump's proposal is to eliminate income taxes for 90% of Americans, those earning under $200,000, we'd need around $600 billion just to cover that gap. In other words, we'd need 3 times more tariff revenue than we're currently collecting. That would require massive across-the-board tariffs on nearly everything we import. And that's assuming no one retaliates, no supply chains shift, and prices don't explode. As someone who lived through the inflation spikes of the 70s and the job dislocations of the early 2000s, I've learned to look beyond headlines. Big numbers don't always mean big solutions. They can hide fragile assumptions. Don't get me wrong, the idea of using tariffs to fund tax relief is compelling. It's simple. It sounds patriotic. It shifts the burden away from income and toward consumption. But simple doesn't always mean smart. We have to ask, is this sustainable? Are we building a bridge to long-term strength, or a house of cards that collapses under global pressure? And that brings me to the next point. Not everyone benefits equally from this system. Some sectors thrive, others struggle to stay afloat. So let's dig deeper. Who wins, who loses, and what does that mean for your paycheck and your grocery bill? Let's find out. Let me ask you something bold. What if we could live in a country where the IRS never knocked on your door again? No W-2s, no April dread, just tariffs, quietly collecting revenue every time something is imported. Sounds clean, sounds simple, sounds kind of brilliant, right? But here's the hard truth. The numbers don't lie, and they don't always support the dream. Let's walk through the math together. Right now, the U.S. collects about $2.2 trillion annually from individual income taxes. If Trump's proposal were to fully eliminate income tax for those earning under $200,000, that covers about 90% of American taxpayers. We're talking about replacing roughly $600 billion in revenue. To reach that with tariffs alone, the U.S. would need to triple or even quadruple current tariff collections. And that's assuming no drop in imports, no retaliation, and no domestic inflation. That's a pretty optimistic world, one that may not reflect the complex reality we live in. Just look at the 2018-2019 tariff escalations with China. Prices rose for things like washing machines and construction materials. Small businesses struggled to adjust, especially when alternative supply chains weren't available. And American consumers, well, they ended up footing the bill quietly in their receipts. So yes, you might save on income tax, but you could easily spend more at the store, at the gas pump, and even at the pharmacy. Now here's where it gets personal for me. I've run a small business. I've had to balance books, pay payroll taxes, and make tough calls to stay afloat. If you shift the tax burden too far onto consumption, businesses like mine and people like you could be squeezed from both ends. Because here's what isn't always obvious. Tariffs aren't invisible. They just hide better than income taxes. And the people who feel them most are often the ones with the least wiggle room. Now, I'm not saying the idea is all bad. There's a case to be made for reducing dependence on income taxes and encouraging domestic production. It could, in theory, simplify the system. But going all in, that's not a tax plan. That's a gamble with real consequences. And before we make a bet that big, we owe it to ourselves to ask, who's really paying the price? Because the answer might surprise you. Next, let's break down exactly that. Who benefits from this tariff-heavy model? And more importantly, who gets left behind? Let me paint a picture for you. You're a steel worker in Ohio. Tariffs go up on foreign steel. Overnight, demand for domestic production increases. Your factory gets busier, overtime picks up, and there's talk of new hiring. Feels like a win, right? But now imagine you're a small furniture maker in North Carolina. You import parts from Asia, screws, fabric, even foam. Suddenly your costs jump 20%. Margins shrink. You either raise prices or lay people off. That's the flip side of tariffs. Someone's win is often someone else's loss. Let's talk about who's winning. Manufacturing sectors, especially those tied to raw materials like steel, aluminum, and even textiles, have seen short-term gains when tariffs target foreign competitors. Domestic suppliers get a boost. Some factories reopen. There's a certain pride in Made in America making a comeback. But these wins are often narrow, and fragile. Now, look at tech. Many tech companies rely heavily on global supply chains. Laptops, phones, servers, they're all built with components from dozens of countries. When tariffs disrupt that system, costs go up. Innovation slows down. And the end user, you and me, we pay more for the same devices. Retail is another battleground. Big box stores like Walmart or Target can sometimes absorb tariff hikes. They negotiate better deals. But mom and pop shops? They don't have that leverage. If import prices spike, they either pass it on to customers or take the hit themselves. And too many choose to close shop altogether. Then there's the consumer, the silent participant in all of this. We're not at the negotiating table, but we feel every price increase at checkout. Groceries, clothes, electronics, even things like diapers and toothpaste. Tariffs don't come with labels, but their effects show up on your receipts. I'll be honest, I believe in fair trade. I believe in supporting American workers. But we have to be honest about the breakdown and who carries it. This isn't just about numbers. It's about people's lives, businesses, and budgets. Tariffs aren't inherently bad, but they're not magic either. They shift pain and benefit across different parts of the economy. And too often we don't talk about the full picture. And that full picture gets even more complicated when you bring China into the mix. Because with China, we're not just talking about tariffs. We're talking about intellectual property theft, market access, and national security. So let's unpack that next. Let me tell you, tariffs are only part of the story when it comes to China. In fact, they might be the least complicated part. What really sets China apart isn't just trade imbalance. It's the rules they play by, or rather, the ones they don't. Let's start with intellectual property. IP theft. For years, American companies entering the Chinese market have faced an impossible choice. Give up your tech or get out. If you wanted to do business in China, you often had to enter a joint venture with a local Chinese partner. And more often than not, that partner was tied to the state. Your technology? It didn't stay private for long. I remember talking with a friend who worked in industrial robotics. His company spent a decade developing proprietary software. 18 months after signing a partnership in China, knockoff versions started showing up on the global market. Same UI, same code, just in Mandarin. That's not competition. That's theft. And the frustrating part? When American firms try to fight back legally, they hit a wall because Chinese courts don't operate like ours. There's no transparency, no real path for enforcement, and even when rulings are handed down, they're rarely honored in practice. This creates an uneven playing field where U.S. companies take all the risk and China reaps the rewards. But it doesn't stop there. Now we're talking about Chinese companies listed on U.S. stock exchanges, some of them massive household names in Asia. They've been able to raise billions from American investors without playing by the same rules as domestic firms. They don't always comply with U.S. accounting standards. They're not fully audited, and when regulators push back, some threaten to leave, or worse, ignore it entirely. I'll be honest with you. As someone who's invested in the market for decades, that concerns me deeply, because trust is the bedrock of any financial system. And if some players are allowed to operate outside the rules, the whole game suffers. That's why recent efforts to delist non-compliant Chinese firms matter so much. It's not about politics, it's about fairness, transparency, and protecting American investors. When we talk about trade with China, we can't limit the conversation to tariffs. We have to include things like data privacy, national security, forced tech transfers, and yes, the integrity of our capital markets. This isn't about fear-mongering. It's about facing reality and understanding that China isn't just another trading partner. They're playing a fundamentally different game. And if we're not careful, we're the ones who end up playing by their rules. Now, this brings us to a larger question. Can we be tough on trade without isolating ourselves from the world? Let's explore that next. Have you ever seen someone walking a tightrope, wobbling with every step, trying not to fall? That's exactly what America risks today with strategic tariffs. Let's take a step back to the 1930s. The Smoot-Hawley Tariff Act was passed, raising tariffs on thousands of imports. The goal was to protect American farmers and manufacturers. But what actually happened? Other countries retaliated with their own tariffs. Global trade collapsed. In the Great Depression got even worse. It was a classic case of good intentions leading to devastating consequences. Now fast forward to today. Trump's new tariff strategy aims to be different, more targeted, more strategic. Instead of slapping high tariffs across the board, the plan focuses on specific countries and sectors that are seen as threats to American industries. For example, tariffs would hit Chinese manufacturing hard, where issues like intellectual property theft have long been a sore point. Meanwhile, allies like Canada and India could see more careful, negotiated treatment, not blanket penalties. On paper, this seems smarter. Selective tariffs could theoretically apply pressure without isolating the U.S. from global markets. But let's be real, retaliation is still a very real risk. Countries don't like being singled out, and they have tools of their own, counter tariffs, forming new alliances, shifting supply chains away from the U.S., and here's where I get a little concerned personally. Tariffs sound strong and patriotic. We're protecting our own, but they can backfire quietly. Prices can rise for everyday goods. American farmers might suddenly lose access to foreign buyers. Small businesses who rely on imported materials could find themselves squeezed between higher costs and lower sales. It reminds me of trying to balance on that tightrope again. Lean too much one way and you lose your footing. Lean too much the other, same result. Success demands incredible precision, constant adjustments, and a lot of humility to admit when something isn't working. The big question is, will this new strategy avoid the mistakes of Smoot-Hawley, or are we heading down a similar road, just with a fresh coat of paint? And speaking of unintended consequences, next we'll explore a deeper issue that goes far beyond tariffs, one that affects the very foundation of U.S.-China relations. Let's dive into it. So let's take a moment to breathe and reflect on everything we've uncovered today. We explored a bold vision, replacing income taxes with tariff revenues. We looked at Trump's hands-on negotiation style, the new art of the deal in action. We examined the record-breaking $15.9 billion in the tariff revenues, but also questioned whether it's truly sustainable. We wrestled with the idea of swapping one major tax system for another, realizing it's a dream with real risks attached. We uncovered who might win and who might lose, from manufacturers and tech companies to everyday consumers like you and me. We went beyond tariffs to see China's deeper issues, like intellectual property theft and court access barriers. And we carefully walked the fine line between using strategic tariffs and risking global isolation, learning lessons from history's painful mistakes. Now, here's the real question for you. Is this strategy realistic? Is it a true path toward revitalizing America's economy? Or are we betting the house on a high-stakes gamble? Personally, I believe bold ideas deserve bold conversations. But I also think we owe it to ourselves and future generations to approach big promises with clear eyes and cautious hearts. It's not just about loving or hating a leader. It's about asking, will this really work for all of us? Will the benefits truly outweigh the hidden costs down the line? I would love to hear what you think. Seriously, your opinion matters. This isn't just a headline or a debate on TV. It's about the real future we're all walking into together. So if you found value in this conversation, please take a second to like this video. Leave a comment below and share your honest thoughts. Agree, disagree, or anywhere in between. And don't forget to subscribe for more grounded, thoughtful discussions, just like this one. Your voice helps keep this community strong, informed, and ready for whatever comes next. Thanks so much for spending your time here with me. I can't wait to hear what you have to say. See you in the next video.